Good evening, everybody. Tonight we have the honor of having Toni Hansen with us. Toni is the president and co-founder of Trading from Main Street. She is a veteran trader and an award-winning author and a leader of the market education since the late 90s. And she also speaks at major industry conferences like
Good evening, guys. Can you hear me okay? Okay, a little bit of a crazy start here. My 2-year-old decided to install Windows updates on my computer before we got going, so that was a little fun. Find the drawing tool. Okay. Well, can you guys see my arrow okay? Okay, perfect. All right, we will have to make do with that for now. All right. Thank you for joining me tonight, guys. We have a pretty in-depth topic we're going to be going over tonight, and it's dealing with what I call momentum gaps, and particularly looking at momentum gaps for types of gaps that are most likely to lead to multi-day trend potential. So we're going to start by looking at a couple of major types of gaps to begin with. So the first type of gap is going to be a common gap. Then we're going to look at breakaway gaps, runaway gaps, and exhaustion gaps really quickly, just to give you guys an idea of the types of gaps that we deal with. So the first type of gap is what you would refer to as a common gap. Now, a common gap is pretty small. It's something that happens, pretty much every day where you'll have some sort of minor open from one trading day to the next. So they're really common when you're dealing more with a tight trading channel. It might be a tight upside or downside trading channel like you have here on Apple, or it might be within a sideways trading channel like this. So for example, you can see, here's the close on this candlestick here, the beginning of this blue circle heading into March, and a little bit of a minor upside gap that next day. So it's a really small gap that takes place. It doesn't really have much impact on what we're getting as far as like major follow through the next day as far as momentum goes. So when you go and look at the next type of gap, that is the breakaway gap. And a breakaway gap is a little bit different because you're dealing with a break out of a major trading channel. Something that is coming out of, it could be, for example, a downtrend channel like you see here. This is GWPH from this week, GW Pharmaceuticals. So this was a major example of a breakaway gap. And you'll notice that there was primarily a nice downtrend channel in play throughout most of the second half of March and throughout the first couple of weeks of April. Now, these breakaway gaps are the ones that often have the best momentum potential for these multi-day trends. So these are the ones that we're going to be going into a lot more detail here a little bit later on tonight. The next type of gap, though, that I want to share with you is what's called a runaway gap. And a runaway gap is really common when you have that second day following these breakaway gaps. And usually you'll have one or two runaway gaps in a row. And after that point, you'll tend to run into trend exhaustion, and you'll end up with perhaps an exhaustion gap. So GWPH, GW Pharmaceuticals here, had really nice examples of three major types of gaps that we watch for. Now, with an exhaustion gap, The thing that you usually look for when you're looking at an exhaustion gap is that it's often an upside gap that follows a major move, which I refer to as an impulse move. So when you're looking at any time frame, any chart, you're going to have these back and forth waves that are taking place. And you'll notice that a lot of these waves have similar kind of length or size in terms of how far or how low they'll go before you'll see a corrective type of move. On this chart, for example, we have a couple of different types of impulse moves. We have one here, or a couple different lengths rather. We have one here going into March. We have a little bit of a larger one on the downside here heading into April. And then you'll see these smaller impulse moves that take place within these channels. Now, an average impulse move is really important to pay attention to, and it's something that I'm going to look at in a lot more detail here a little bit later on, because when you hit these extreme levels with these impulse moves, so for example, this one that began here going into March, you'll notice that's about the same size as this run we had here just this week. That's where you often get major levels of support or resistance, and these can be where these exhaustion gaps will hit. So they'll jump into these extreme levels. Often you hear them referred to as like a measured move on the daily or the weekly time frame, and then they'll react off of that level. So exhaustion gaps can often be the end play in what you will see coming off of a breakaway gap. It can be a good clue that you're looking at a level where you should be taking gains. And so that would take place if you've seen usually 3 gaps in a row. That third gap is most often going to be an exhaustion gap. That's going to lead to some sort of correction, whether it's a longer intraday trend or a reversal that might happen at that level as well. So 3 gaps in a row, third gap probably going to be an exhaustion gap. Now, let's look at this breakaway gap in a lot more detail here, because these breakaway gaps are the ones that often have those multi-day trend moves that follow them. But there's a lot of details that you really have to watch for when you're looking at a breakaway gap that are going to clue you into whether or not, for example, a gap is too small, too large, occurring at the wrong place with the wrong momentum. You'll get a better feel for it once we look at some of these details. Let's start by looking at these ideal traits for breakaway gaps. Now, there's 3 major traits that I watch for. The first one is a gap that is less than 1/3 the size of an average impulse move. The second is if you're looking at a bullish breakout, we're looking at the prior day's close follows an intraday downtrend or period of congestion. And then the third one is to look at volume as it's taking place leading into the gap. So in that one, you're going to be looking at volume that declines leading into a breakout, leading into these gaps. Now, let's look at each of these in detail. So the first one, when we're looking at gap size, for a long time, the kind of criteria that I used to share with a lot of traders that I was working with on how to trade gaps was to look at gaps that were an average of less than twice an average day's range. And looking at these smaller gaps had a better chance of giving you a stronger follow-through the day of the gap itself. So in Apple today, for example, if you look at this chart here that just took place this morning on Apple, you'll notice right away that this gap that took place today was much larger than twice an average day's range. As a result, it doesn't follow through very well today. But what's even more important, and a shift in how I've changed teaching gaps, is to look and focus more upon these impulse moves and the impulse move concept as opposed to looking at an average day's range. Because sometimes you'll have breakaway gaps that are triggering breaks on a larger time frame, like a weekly time frame or even a monthly time frame. So you can get a larger gap that will follow through for multi-day moves, but it might struggle still that first day of the gap. And so if you're looking at an impulse move that is taking place, if you're in that lower 1/3 of an average impulse move for the size of the gap itself, you have a good chance of getting a strong trend day that day, or at least a strong trend throughout the morning. So with a gap like this in Apple, if we look at some of these previous impulse moves that took place, you'll notice that a lot of these upside swings and downside swings really have about the same price movement to them, around 40 points or so. And coming off of this low here just about a week or so ago, you'll notice that we already have that 40 to 50 point move in very, very easily. So it's at the upper level of an impulse move, and hence it had a lot more difficulty getting any sort of intraday follow through as a result. So here's another example of this larger gap compared to these previous impulse moves that took place back in January, and you'll notice that the day of the gap itself, it didn't really have much follow through that day. Yes, it was able to push lower a little bit, a couple of days that followed, but it wasn't anything that was a really strong move. So it has a really difficult time following through very well on the gap for the multi-day moves. If instead we'd seen a gap to maybe right around here, kind of that upper third or so of this gap itself, there would have been a better chance that we would have seen a strong trend day throughout that entire day. And a lot of times these gaps do correspond with earnings or warnings or a lot of unexpected news that might come out. Breakaway gaps, one of my favorite times to trade them does happen to be when earnings season's rolling around. Even more so perhaps when warning season is out ahead of earnings, because those tend to be even more unexpected. So you can get some more extreme moves coming out of those instead of just waiting for the earnings themselves. Usually, when I'm scanning for these gaps, one of the things that I'll watch for is the night before earnings are coming out, or the day before earnings are coming out for the next day. I'll kind of scan through quickly, the major players that are going to be announcing the next day, and look for things that are in these trading channels, for example, ahead of those earnings, or might have some smaller counter trend moves that could lead to some really nice follow through the next day. If we look at Apple here and we go to this larger weekly time frame, even though the impulse move on the daily time frame was pretty average based upon where we saw that gap this morning, if you look at some of these previous impulse moves, you'll notice that there is potential for larger movement on this larger time frame. So we have a large impulse wave here heading into 2012, and then we have some of these smaller ones, the smaller scale ones taking place in between. So leading into the second half of 2013, we had two good examples of smaller impulse waves within a larger upside impulse wave. Longer correction here, and now the gap today, it basically broke this out of this trading channel here. So there is the possibility that this could follow through for a larger time frame move that could lead to, even up to around 625 or so. That would be that measured impulse move on the weekly time frame. But because the daily time frame was hitting those exhaustion levels, we just didn't see a nice trend day today. And it could even fall into a trading channel for a couple of weeks before you see that follow through on the weekly time frame. So if we go and look at this concept and this idea of the size of the gap as it compares to these impulse moves, you'll see two examples of gaps that took place over the last 2 days here in Athena Health Inc. Athena, this is one of the stocks that I really like to trade a lot, and I'm going to show you guys another example here of this in just a couple of minutes. But you'll notice here, heading into yesterday, that there was an intraday impulse move on this 5-minute time frame around 1300, 1 o'clock Eastern, and it started moving higher into the closing bell, coming out of this trading channel. So momentum was already on the move when it gapped higher. So this was essentially an exhaustion gap. Even though we didn't have, those multi-day trend moves, we had that same concept on the intraday chart, the 5-minute time frame here. So the gap itself intraday was an exhaustion gap, even though it didn't play out as such on the daily time frame. Now, heading into today, on the other hand, the gap that we saw, this morning is a little bit better because you had it coming out of this trading channel where it had an impulse move heading into the channel. So when it broke that channel, there was a lot more room that it could follow through in order to follow through and create that secondary impulse move intraday. Now, if we go and look at another chart of Athena, this is a larger time frame. This is a trade that I had a couple of months ago. And I taught this class, or a variation of this class, in New York at the expo there. And this was a trade that I had taken just before that particular expo, and it had a couple of really nice examples of these breakaway gaps. The second concept that I want you guys to watch for with these breakaway gaps is the type of action heading into the gap itself. Now, on that intraday chart here, this 5-minute time frame, the first thing you'll notice with this first gap is that it's moving up in the direction of the gap. So the gap extends a move that's already in place. An ideal breakaway gap, on the other hand, has a counter trend move heading into that gap. So it'll actually be moving against the direction of the gap. So it creates this trap situation where there's a little bit of bearish action on the downside, there's a little bit of corrective action. People are just really not too convinced that they want to be on the bullish side of this yet, but at the same time, they're not necessarily too convinced they want to be on the bearish side either. And I see a lot of people posting in here on volume, and absolutely volume is a primary thing that you'll see on these counter trend moves heading into the gap. So, for example, this pullback here, the volume was actually lighter in that last little portion than you'll see earlier on in the congestion. So it's a little hard to see here because you can see the spikes are kind of distorting it. On some of the other charts I've adjusted so that you can see it a little bit more clearly, but you'll usually see either flat volume as it's pulling back, so one bar will be approximately the same as the next, or you'll see a volume drop as it's pulling back. Now, these more gradual corrections are really nice where you get a lot of overlap from one bar to the next. Those create some of the stronger breakaway gap strategies, which you consider a continuation play on a breakout that had taken place earlier in the month. So I didn't really see a decent breakout strategy based on the intraday time frames. This is a daily chart that we're looking at here, and I usually look at multiple time frames. So I'm using like a 90-minute, sometimes even 120-minute for timing some of these bigger swing trade strategies. And the intraday action was just too choppy to give me a really solid setup. So even though I started building into the position a little bit earlier, I didn't have any sort of major position on when the gap took place. And I used the gap to add into the position. And this is an example where the gap itself was about 3 times an average phase range, maybe even 4 times, because it's closing near lows back here at the beginning of February. So you have one of those larger gaps, but if you look at the previous impulse move from back in October, it was still in that lower portion of that impulse move. Now, it was a little bit closer to the 50% point than the lower third, but the lower third is a guideline to be used as the strongest type of breakaway gap. You have the least amount of chance of this move basically just following through right away out of the morning and then falling into a trading range throughout the rest of the day. If the gap is smaller, maybe right around where this blue point here is, that's where you'll have a chance that it will open and you'll get some really nice continuation strategies that will really just continue to play out over and over again throughout the day, as opposed to the larger gaps, which often might have that rush right away in the first 15 minutes to 30 minutes of the day, And then you'll find it really difficult to get continuation strategies throughout the rest of the day. You might find continuation the next day, but it might take place with a runaway gap. So in order to get the best intraday entry on something that has a little bit of a larger gap, you might even want to drop down to a tick chart on some of these to watch for intraday continuation strategies in those first 5 to 15 minutes of the day. Otherwise, you might just get stuck watching that entire move play out really quickly early on without as much a nice follow through later on. Now, if we go and look at another example here, this is another one that was from this week. This is Elizabeth Arden, and you'll notice that heading into the gap that took place yesterday, we had a move that was already on the upside, and it actually had a pretty bearish bias going into the gap. This is another one I assume was based on earnings. I didn't trade this particular one myself, but I wanted to show you how these counter trend moves can really help impact the day of the trade. So the day of the gap yesterday, we had this rounding off at highs and this lower level base in here. Basically, it was creating this inverse cup with handle pattern. Volume was dropping off throughout this channel. So if this had gapped to the downside, that would have triggered a really nice breakaway gap on the downside for continuation. Instead, there was a bit of an upside surprise, but that move to the upside heading into the gap was not really ideal to help with the follow-through on the upside. So it really struggled to pull through and continue to move throughout that trading day. Now, that being said, even when you don't have that ideal action that first day, that doesn't mean that you're not going to find a continuation strategy later on in that afternoon, or maybe even heading into the next day. So Elizabeth Arden actually did end up following through this morning, and this had a really nice trading channel throughout the day yesterday and broke to the upside heading into this morning. So when I'm looking at gaps and creating my watch list, I'll look for these breakaway gaps and kind of put them on a watch list that I'll watch for a couple of days, where even if that first day doesn't look that great, if I look at it later on in the afternoon, heading into, maybe after hours, just, taking some time to go through those top gainers and top losers for the day, things like this will stand out, where they have that congestion that has that potential for that continuation into the next day, even if it wasn't that great as far as the gap trade day itself. Because on that larger daily time frame, it had two impulse moves here in February that made up a larger impulse move throughout February. And so that still had more potential basically into this congestion here back at the end of last year. So the potential was still there for continuation on the move. And basically that looking at that impulse move is really what can give you that heads up for whether or not these gaps really do have that potential to follow through. Or if you're going to be looking at something, you might get trapped in and just kind of get stuck. Maybe most of the move has already taken place by the time that gap has finished. If we go and look at volume, here's another recent one from today. On this case, we have a downside gap, and it's similar to that cup with handle, inverse cup with handle we saw on the previous chart. It's, a bit of a head and shoulders here with a continuation on a bear flag type of move, but same idea. And really what you want to see with this counter trend move ahead of the gap is a decrease in volume. The last thing that you want to see is an increase in volume if it is moving to the upside. It could be flat volume where you'll have some higher volume down over here, and then it kind of goes flat for a little while, but you don't want to see it increasing. If we go and look at this intraday, it kind of gives you a little bit of a better picture. And on these, I cut off these extreme volume charts, so the volume's actually higher on these last couple of bars here. But I wanted you to see the volume action as it was just heading into that gap itself. And this is where you often see the most marked dramatic change in volume is right at the very end before the gap happens. So this kind of downside triangle type of formation is really common, even if you see kind of flatlining volume a little bit earlier on. We did have some volume dropping off here a little bit earlier within the congestion. Even as it was pulling higher, that volume was dropping, which is showing me that there's not really a strong buying interest there. Even when this pulls to a slightly higher high here, there's not much volume to accompany that move. So there's not a lot of interest for this on the buy side. Another thing you can see when you're looking at these zones of congestion and these counter trends moves ahead of the gap is many times you might see upper tails that are larger than the lower tails within that congestion. This one doesn't show that concept as clearly, but it is something to watch for and just something that you're going to notice a lot of times ahead of these gaps, really ahead of any breakout from a zone of congestion. If you see a lot of tails on the upside, there's a better chance that that congestion is going to break to the downside, whereas if there's more tails on the bottom, it's more likely that the congestion is going to break on the upside. So that's just another confirmation tool that you can be watching for heading into the breakout gap itself, that if you're scanning pre-market or post-market and you're looking for trades the next day or when the market opens, look for those things to accompany the news that you might be looking at. And that can give you a heads up that, yeah, you might have a decent breakaway gap that's developing. Now here on the CLFD, you'll also notice these smaller impulse moves on the daily time frame and the gap compared to these impulse moves. In this case, it's right around that halfway point, so it left some room intraday, but it's going to make it more difficult for it to continue that trend for a multi-day trend move. It will probably continue to some degree, but there's a better chance that it will have more overlap and that the momentum will shift dramatically. So you'll see these periods where you might have a number of dojis forming following the move, but since it's already had that measured move based upon these previous impulse moves, it's going to struggle a little bit more in most cases to follow through with a really strong trend continuation. There's always exceptions to that, but that's a good kind of idea or concept to follow when you're looking at a boundary or guideline to follow when you're looking at whether or not you really want to hold these for a multi-day trend move, or if you're better off just taking most of your gains the day of that breakaway gap itself. Here's again is that intraday chart here on CLFD. And then here's a recent trade. This is one that I took myself here about 2 weeks or so ago. And we're going to look at how to put all of these concepts together. So when we're looking at the breakaway gaps, one of the first concepts to look at is of course the size of the gap itself. So in this case, we have a pretty minor gap coming out of that channel. It's enough to just break free of the channel itself. And this is really the most ideal size for a breakaway gap. Something that might be, a single day's average day's range, something that again is in the lower third of an average impulse move. We have these previous two impulse moves to the upside back in here within this zone of congestion. So it's a good guideline to look at for the size of the gap. And as a result, it had the best chance of giving a multi-day trend move, of being able to follow through not only intraday, but for several days on end without showing extreme exhaustion. Now, intraday, if we go and look at that really quickly, here's what that looked like. You had a strong push throughout the open and then that period of congestion. So it allowed for a continuation coming out of that congestion. We go back to this previous bar here, previous chart here rather, looking at the daily time frame, and we look at the other traits that I want to see with a breakaway gap. The first one being that weakness, heading into the gap itself. Since this is a gap on the upside, I'd really like to see some sort of downside move over the last 4 to 5 days before that breaks to the upside. And 4 to 5 days is really pretty ideal. If you have a 4 to 5 day move on the downside where it's kind of one bar overlapping the next, really slowly leaking to the downside, and then at that point you have that breakaway gap to the upside, you have a really, really powerful chance that that is not only going to follow through with a strong trend in the morning, but also that multi-day trend move where it could be, that 3-day trend, or it could lead to a multi-week trend. Now, usually on a breakaway gap where I'm looking for a swing trade, the minimum that I'm looking for a swing trade is a 3-day move. Back when I first started this class, we talked about runaway gaps and the other different types of gaps that could happen. And I said, that if you get 3 gaps in a row, your third gap is probably your exhaustion gap. Well, this rule of 3, or this concept of 3 on a trend coming out of these breakaway gaps is really common. And it's not necessarily that you'll always have runaway gaps leading to an exhaustion gap. It could just be 3 days of upside where that trend continues for 3 days, and then you'll see a stall in that trend. And a lot of times, if you're looking at your intraday chart and you're looking at a 15-minute time frame rather, if you put a 20-period moving average on that 15-minute time frame, if you have a trend that is holding that 15-minute, 20-period moving average for 2.5 days, it is most likely to break that moving average between the second and a half and third and a half day. So it's very rare that it will hold that moving average past day 3. And at that point, you're either going to be looking at a shift in the momentum of the trend, where after day 3, it might continue higher, but do so a lot more slowly or more gradually, or it could even reverse at that point. And after that 3rd day, you could be dealing with some intraday corrections that really come against the trend. Momentum plays a big factor here. The thing that you'll notice with this FX energy stock is that momentum on this breakaway gap really increased compared to these previous impulse moves. And this is one of those things that can help you get past that measured move for the impulse move. So it might hit that impulse move length or height, but after it pauses, it could continue because of the increased momentum. So here, it hit that extended level that first day. Basically, these previous highs, it had that average distance where it had that measured move right around $4 a share. And intraday, what happened was it stalled at that level. It paused on the 60-minute time frame, corrected to that impulse move, and then it was able to follow through and continue. But we'll look at another reason why it had that potential here on the next slide. One of the other things, though, that I want to show you here is if you look at volume compared to the end of last year and the selling and the corrections and pullbacks that took place in that move, look at that volume compared to the volume on the most recent pullback and correction over the last month and a half leading to that breakaway gap. You'll notice that it's about 1/3 to 1/2 that volume that we saw at the end of 2013. So there wasn't as much interest to this most recent sell-off as there was that previous sell-off. So a lot of overlap, a lot of really strong intraday moves to the downside, but they're not following through from one day to the next, and they're not getting a lot of interest. In fact, this last couple of weeks even shifted the momentum compared to the earlier part of the trend, where there were 2 waves of downside, these 2 smaller impulse moves, right around to the end of last month. And then the momentum shifted, where it's hugging this 20-period moving average. And that's a really strong heads up that you could have a potential breakaway gap forming. So anything that is hugging this 20-period moving average on the daily time frame, if you have any sort of news coming out after hours, it's quite common that that can lead to a breakaway gap coming out of that channel. In fact, you might have a breakaway gap that doesn't have any news accompanying it when it comes out of that channel. Trend exhaustion that's taking place. Within a trading channel like this, typical trend exhaustion happens after 2 waves as opposed to 3 like you might see in a major uptrend or a major downtrend. So we have these 2 waves in the last quarter of last year. Then we have 2 waves up, 2 waves down. This gets a little bit tricky. You have to go into kind of a little bit of a better understanding of trend development than I have a chance to get into here. But basically, you measure this as the first wave down. This is a period of congestion because each of these corrections is a different period, is a different amount of time, and then this would be considered the second wave down. So I'll talk a little bit more here about trends development in a few minutes, but that's the gist of that. It gets into kind of the trickier details of trends development. And we have 2 waves of upside here. Again, a little bit of a trickier example. You have an initial move. Change in momentum here. Basically, this concept is that this is a trading channel that's tilted on the side, and then the continuation there. First wave down, second wave down, and then a shift in momentum here. So you have trend exhaustion coming into this lower end of the channel, and that helps create breakaway gaps that are purely based on technical reasons as opposed to news-driven reasons. And you can still get really strong multi-day trend moves without the news. And in fact, sometimes they're even better trend moves because they don't have all of that pre-market exhaustion or after-hours exhaustion already factored in. So the ones that are based on news-driven events can really get too extended after hours or too extended prior to the open for a lot of traders to really get into them. So these ones that are not news-driven, a lot of times they'll still show up if you look at pre-market gainers and pre-market loser scans, but they'll have better potential for a multi-day trend move where you'll have a steady trend. If you go and look at that intraday chart here again, you'll notice that it follows through pretty smoothly for several days before it shows exhaustion. So if we look at this, you can see nice steady downside move on the 90-minute time frame. There's a little 2-wave sell-off here ahead of the gap, and volume is lighter during that last wave of selling before the gap takes place. So we have really nice intraday action in addition to what was happening on that daily time frame. Now if we put this into perspective on the weekly time frame, this chart is a little bit kind of squished up here because I wanted you to see these impulse moves on the weekly time frame. If I used a monthly chart, you really couldn't see them at all. But if you look at them on this weekly time frame, you'll notice here back in 2009, this upswing, pull back into the end of 2009, upswing into early 2010. Here we have a bigger impulse move. Then you go back to the smaller one, and a couple of other smaller ones taking place in 2012. And you'll notice that compared to those moves, when we were first dealing with that first day for the breakaway gap here, these previous 2 highs here, it's kind of difficult to see them, but right where my cursor is, those previous 2 highs, that's where it had the impulse exhaustion on the daily time frame, and that's where it was hitting that upper level that was the initial resistance. It hit on day 1 right here, but when you compare that to these previous impulse moves on the weekly time frame, it was still really minor. So it's like what I talked about on Apple, where the daily impulse move kind of exhausted the trend. It made it more difficult to follow through today because it hit that daily impulse move right away out of the open today. Now on FXCN, FX Energy, instead it had a smaller gap and it moved to hit that daily impulse move level intraday. So it still had that intraday potential that it could follow through very easily and hence not be something that would trap you if you got into it right away into the open. Now, on the other hand, if you missed that first initial swing that took place in the first 90 minutes of the day, because it hit that impulse move, measured move in that first 90 minutes, it made it very difficult to get a decent continuation move for a number of hours following that initial move. It needed a chance to rest and, a chance to catch its breath really before it could offer an additional continuation. So it was able to do that intraday, created these 3 waves of nice trend movement to the upside. For those of you that know a little bit about Elliott wave theory, here's your typical 5-wave movement. 1, 2, 3, 4, 5. Now, something that I pay particular attention to that it kind of goes not really in line necessarily with Elliott wave, but is something that I noticed myself over time, is that when you're looking at these waves of price movement, you really need to pay attention to what is happening between each of those waves of price action. So in this example, if we look at this correction here from the first wave of upside to the second wave of upside, notice that from the second wave of upside to the beginning of the third wave of upside, these corrections are lasting approximately that same amount of time. That's really what you want to see happening here in order to show you that that third wave is really a decent exhaustion level for the trend, and that you really should be looking for some sort of signs of exhaustion at that point. Now, because the momentum was still very strong on that third wave of upside, it was able to continue the trend a little bit, but we had a shift in momentum. So it hit a slightly higher high over here, but the shift in momentum further signaled that intraday trend exhaustion. For a swing trader, these would be signs that you would be using to get out of the position and take your gains on a position. Now, I want to show you guys one more example here of putting all this together, and then I'll go into answering a lot of questions that I know you guys are going to have, and I see them posting here already. Here's another example from this week. This is oil. Now, I actually use the futures contract for trading oil, but I was using my simulated account here for putting together the slide projection, and I didn't have my futures on this. So I'm showing you it on USO, and USO is actually the chart that I used when I was talking about it on Real Money Pro. I write for them, participate in their columnist conversations, and I posted this right around midnight Central Time on Monday morning as something to watch for reversal strategy, to watch for a correction. Oil had been in a pretty strong uptrend for a couple of weeks, really a month. It had 2 impulse moves on the upside on the daily time frame, and within that you can see a number of these smaller impulse moves. Now, as far as trend development goes, oil's been in pretty much a sideways trading channel for a number of months, and so I tend to look for 2-wave moves as opposed to 3-wave moves when I'm looking for reversal strategies. One of the things that you'll notice here very quickly is we have a 2-wave move on the upside, and then momentum shifted. And this momentum shift is really key, again, to a sign that you could have a breakaway gap developing. Now, the trigger that I took was based on a strategy that took place ahead of the breakaway gap that you see here on USO. But this was still something that happens very often on daily time frames where you see the same price pattern forming. So I used an intraday strategy on Monday to get into this on the short side, again using futures, not the actual ETF here. But I was able to discern that it had a good chance of even developing a breakout coming out of that based upon the price action going into this move where we had trend exhaustion with the 2 waves within the channel and then shift in momentum and the equal or measured impulse move on the second wave. So first move up, second move up, very measured moves here, showed exhaustion here at the previous high, major price resistance level, and because it hit that price resistance more gradually, it had a better chance of getting a stronger reaction coming off of that resistance level. Now, volume, again, plays a major role here. When this momentum shifts, I want to see volume dropping off, whether it's this momentum shift based on a sell-off that's reversing off lows or going into highs. So you can see that it really starts to shift almost right away. When the momentum shifts, the volume shifts. So even though it's hitting these higher highs, there's no increase in volume as that happens. And in fact, there's a bit of a volume spike here, comes with a little bit of a gap to the upside as it comes into this upper channel level. So it basically was a trap type of gap, and that brought in some volume. But then, as it continued to congest, we once again see volume dropping. And right before the gap, we see some of the lightest volume of this entire counter trends move. So not only do you have the slower counter trends move going against the direction of the gap, you have volume dropping off, and we have really good trend placement to boot. So this created this breakaway gap in the ETF, where for those that trade, the swing trades purely based upon the ETF, that would have been the trigger. But if we look at the potential that this had with the gap itself, you'll notice that there would be smaller impulse moves that took place within the larger waves of price action. And this downside gap here was closing in on those measured moves. So it was a little bit shy of an equal measured move. It still had a little bit of room to go. So the gap was about 2/3 of the measured move. So it still had about 1/3 left before it would hit a major support level intraday on this particular time frame, this being the 90-minute time frame. The result is that it was able to follow through that day to begin with, but then it fell into a period of congestion here. Now, since these larger waves have more room to them, and a typical reversal strategy will have at least 2 waves to it, I am expecting that this has strong potential for a second wave to continue into next week. So I am still holding on to this position on the short side, and I'm looking for continuation really right into the beginning of next month. Because if you look at this zone of congestion here, heading into early April, and we now look at the zone of congestion that's playing out here, you can see that if we look at the time development, this is one of the traits that I talked about when I was looking at that uptrend on the previous chart here. The time development. These equal spacings often lead to another impulse move. So that same idea happens when you're looking at a sideways trading channel, where if you look at previous levels of congestion, this is almost like taking the concept of the impulse move, but applying it to time, so a time move. So that tells me that if I'm looking to add to the position, or let's say hypothetically I had taken everything off at that first impulse move based on the 90-minute time frame, and I wanted to get back into the position, then right around here is where I would expect that ideal entry to be. And if we look again at the impulse action, right around here is where I would expect that next support level to be, right around 36 on USO. So some scanning tips for watching these breakaway gaps. One of the things I'll look at is, like I mentioned earlier, I'll look for, what are the earnings that are coming out? And I'll scan through that list. Does anything stand out where it might have a gradual counter trend channel or congestion that a break with a gap could lead to a really nice trend move? Another thing is I'll look at pre-market gainers and pre-market losers. A lot of charting platforms will have these built in, so you can scan for pre-market gainers and pre-market losers well ahead of the market open. And then there's a lot of scanning platforms that you can add to it as well. So if you don't have a built-in scan, like TradeStation has built-in scans, for example, then you might be able to add on to it. For example, Trade Ideas is one that has a lot of gap strategies to it, so you can use that to look for these pre-market gainers and losers as well. Usually, my list will end up having about 3 to 5 things that kind of I get shortlisted heading into the day. So before the market even opens, I'll have several ideas that I think have really good potential for these multi-day trend moves, or at least having a strong trend throughout the morning. And then you'll have to watch, for the size of the gap itself when it really does open, and where that gap level, that open level, really compares to what those previous impulse moves were, to tell you, is there really that potential that it can follow through well? And don't just look at the impulse moves on the daily time frame. Take a look what is happening on the weekly time frame too, because even though it might be hitting those extreme levels on the daily time frame, you still might have a little bit more potential when you're looking at that weekly time frame. So that might give you a potential for a position trade, or even a little bit of a longer investment type of strategy. So thank you guys for joining me today. I hope you picked up a lot of tips on how to look for these momentum gaps and things that will really stand out as pros for these gaps that are going to help you with those multi-day trend moves. If you want to learn more about trend development and signs of trend exhaustion, some of those things that I talked about really towards the end of today's presentation, but get into a lot more detail on it, I have a class available. It's 3 signs of trend exhaustion, and I think my admin even threw on another bonus for that I don't have listed here, another class that I recorded that deals with trend development. I know he's adding that to the page. And so go check that out. You can read more about trend exhaustion and the things that I look for, and how to recognize where you're really coming into the end of a trend move. Not only for timing pivot strategy. So example, on this chart here shows a reversal strategy that I took on the dollar yen, but also how to use this trend exhaustion to time your target and to take advantage of getting out of your position, and really how to kind of get the most you can out of it. So a lot of traders I run into, will say, well, I got into the position perfectly trading. I just didn't have the confidence for holding for those larger target levels, even though instinctively I knew that there was more room to it. I didn't know the exact reasons why there was more room to it. So this class here, 3 Signs of Trend Exhaustion, goes into exact things to look for, just like I went through here in today's class, but in a little bit more in detail, focusing purely on trends. So I hope you'll go and check that out. Let me go through here and answer a couple of questions that you guys have. First of all, thank you guys. I'm seeing some really nice posts here, so thank you on that. Do I have a gap course? Yes, there is a gap course available. It's at ToniHansen.com. That's a 4-hour gap course as well. Let me scan up through here. I'm going to go up to some of these earlier questions here, guys. I know a big question that I had looking at multiple time frames. Which time frames do I prefer? Why do I look at some compared to another? I look at many multiple time frames. So even though the charts that we had in today's presentation were primarily 90-minute time frames and daily time frames, when I'm looking at actually timing my entry on these gaps, that's where I get down to the smaller time frames. That's where I get down to looking at tick charts. I look at sometimes even 1-minute and 2-minute time frames on some of these gaps. And of course a 5-minute, a 15-minute, a 30-minute. Those are the basic intraday time frames that I'll use, and that's most common within those first 2 hours of the day, and I kind of start at the smallest level and work my way up. So on a lot of these breakaway gaps, I'm actually using tick charts for timing. And the reason that I'll use a tick chart as opposed to like a 1-minute chart or a 2-minute chart is because you can see those swings back and forth a lot more clearly than you're going to see on just a 1-minute chart or a 2-minute chart. So you can see the intraday strategies developing a lot more clearly. And you can see like signs of trend exhaustion, for example, on a tick chart that you might not see at all on a 1 or a 2-minute chart. And the gap course actually goes into those intraday strategies too. But that's why I'll use the multiple time frames. But the 90-minute and the daily time frames are the most important for determining whether or not the gap is actually a viable gap for multi-day trends move. So if it doesn't have the characteristics that I talked about tonight on those particular time frames, it's going to be a lot more difficult to get those multiple day moves. You know, I showed you that chart of Anthem that had that intraday time frame. We were looking at a 5-minute time frame, and you could see the gap on that time frame and the impact the size of the gap and the movement into the gap all had on it. But when you were looking at how to trade that gap, I would have traded it purely based upon what was happening on that smaller time frame. You know, looking at the 1 to the 5-minute time frame, as opposed to trading it with the intent of looking for a multiple day trend move, because that's the time frame that the main strategy developed on. When you're looking at breakaway gaps, your main strategy should be something that is developing on at least a 60-minute time frame. Well, you might see, you know, an intraday strategy like maybe an inverse head and shoulders pattern is forming at lows. So you can see those shoulders and the head on a 30-minute time frame. And you'll see that development intraday, but then it's breaking out on the larger time frame, and that will give you that breakaway gap. The smaller that counter trend move is really ahead of the breakaway gap, the smaller the potential usually is. So you usually have the smaller impulse moves as opposed to the larger ones. Now, let me see here. I'll scroll down. If you have any other questions, you know, definitely post that here. I have plenty of time here for a couple of more questions. We ran a little bit late here. Can you have, let's see, gap characteristics using a guild? Basically, you know, no matter which security you're trading, particularly when you're using stocks or options, all of these characteristics are going to be the same. My trading really doesn't change too much based upon the type of market that I'm trading, so I'll use the strategies in a lot of different markets. The thing, and one of the questions here is, you know, can we look at how to trade, you know, the dollar yen using this method? Well, the thing with the dollar yen and these currencies are you'll have the gaps taking place over the weekend, but that's really your only opportunity for trading the breakaway gap type of strategy. Certainly, you know, the signs of trend exhaustion will come in incredibly handy for that. But the gaps themselves aren't going to be as common as you're going to find in individual securities. Let's see here. Question on what charting platform did I have here? I was using TradeStation for this. So let's see. Do I also take into account pre-market and after hours open charts for equities? Absolutely. You can definitely look at those as well. So that can give you an idea for getting into some of these trades even before the regular session began, because you can have strategies that are setting up early. So yeah, if you have pre-market, definitely look at those as well. All right, guys, if I missed any questions, you can contact me at my website. Just go to tonihansen.com, and there's a little Contact Toni button in the very upper right-hand corner. So message me up there. It might take me, I'm just going to warn you here, it might take me a couple days to get back to you because I'm loading a moving van tomorrow, and I'm moving 2 states away. So it's going to be getting a little bit crazy here the next couple of days, but I will get back to you definitely, you know, very early next week as I get settled into my new office in Columbus, Ohio. So thank you guys for taking the time to join me, and you know, I really appreciate you taking this time out of your evening to join me. I know that they will be posting this video, recording this video, so they will be getting you a copy of that. So keep an eye on your email, and they'll send you that out so that you can go back and review this. All right, guys, have a wonderful evening and have a wonderful remainder of the week, and I look forward to talking to you again.